You've heard a lot about the housing market, you've heard a lot about the economy, and you know that we've declared a national housing recession. But do you know the current state of the union? If not, this episode's for you. So we finally started to see home values come down, and we know that we've all seen the national media and felt that rental prices have gone up, and gone up very, very quickly, which is not uncommon. When real estate values are high, if interest rates are low and affordability is still there, it's not going to affect the rental market because people could just buy a home if they've saved enough money. But as interest rates rise, and in this case 3 times what they were just a year ago, that means affordability, with home prices still high, is damn near zero. And that means people have no choice but to rent. And landlords and large companies that own properties know this. And they take advantage of the market by raising rents commensurate with that, because there's now an influx of demand from people who cannot afford to buy, who now need to rent. So if you're feeling all this and you're asking yourself, like, when is this going to change? Well, change is coming. And let me tell you why. According to Fortune, housing prices plunged 77% in U.S. metro areas. The turn has, quote, finally happened, end quote. And according to the American Enterprise Institute Housing Center, prices nationwide, measured month over month, fell for the first time in August since the depths of the COVID crisis, which, as you may remember, was a recessionary economy, retreating 1.6% from July. Now, this is really, really important because so many people that were around you who had a bias said that home values were not going to go down. And while I'm sure the new rhetoric will be home values won't go down year over year, but they certainly have gone down month over month. But that doesn't mean that we're in a, quote, housing market, because we have a housing market impacted by the recession, at least anyway, because we have a shortage of supply. And what I've said routinely on this channel and on social media is that demand without affordability is not demand. And what we are starting to see is the result of that. As a matter of fact, U.S. pending home sales post a 3rd straight monthly decline in August. According to the National Association of Realtors on Wednesday, its pending home sales index, based on signed contracts, dropped 2% to 88.4 last month, the lowest level since April of 2020. Contracts have declined in 9 of the last 10 months. And the reason why that's important is we are currently in October as I record this, or just before October, and that's effectively 9 months. And one of the things we've said repeatedly on this channel is that the National Bureau of Economic Research, or NBER, will ultimately declare a recession after the second negative quarter of GDP growth, which, if you recall, was June 30th of 2022. Unfortunately for all of us who want to deny that we're in a national recession, we have to look at the fact that National Bureau of Economic Research typically is a retroactive declaration, meaning the first month of the first quarter with which there was negative GDP growth is the beginning of what will ultimately be called a recession. So despite the fact that we are in an already declared housing recession, when this happens, you can see that the 9 months of retreating transactions on the real estate side has been indicative of the recession, going all the way back to the beginning of the first month of the year, January 2022, which will be declared the start of the recessionary economy. And all of this winds up in a set of circumstances where you're asking yourself, how will this impact me and what's going to happen to my ability to purchase? Well, it is widely believed that some of the largest markets, starting on the West Coast, have already seen declines. And you can evidence that in states like California, where you've seen the average home value go from $760,000 in May to $750,000 in June to $740,000 in July. And that number continues to decrease, particularly because the large amount of high-end homes here and how expensive those homes are. In areas where you had a 20+% correction in a single year, where it went all the way up, and all the way up again the next year, you'll see that same correction go downward when values start going down because the demand isn't there, because there is not affordability. And what this ultimately means is, as interest rates rise and home values come down, there's going to be an inflection point. And when that inflection point happens, that means that there's going to be no buyers left in the market who can buy, and values will continue to drop. And that number is expected to be somewhere between, call it 10 to 20 or 25% in some of the areas that had super high growth. That isn't going to be a, quote, crash, which is a very nebulous term that I don't like and I don't recommend anybody uses, because a crash going down of, call it 20%, would only eviscerate the last year in some of these large markets of increases in values. So you can't necessarily look at a large number like 20 or 25% as a correction in value downward as a market crash. And I don't think anyone should use that term unless there's a prolonged impact that was beyond what we can expect and foresee. At this point, what I will tell you and everybody else is there is a correction coming in values. In markets that were propped up significantly by high demand, think Austin, think California, think Florida, and some parts of New York, as well as Arizona and Nevada. Those areas are going to have significant double-digit corrections, call it 10% or more, while some other places around the country might not be as impacted, think possibly North Carolina or South Carolina. While I do think those places will have values go down, what we've seen already is a trend on the coast of the West Coast going towards the Midwest, hitting Las Vegas, hitting Arizona and Phoenix and some areas along the way, and certainly getting into the Texas market now as well. We're starting to see this migration in adjustments in value downward toward the East Coast. It doesn't always work that way, but it seems to be working that way in this particular economic environment. And maybe that just has something to do with inflation and these particular economies being very expensive to live in. That being said, change is coming. If you were waiting, I will tell you right now, we have always anticipated that October 2022, the month that you probably are seeing this, was going to be very, very indicative of the future. And the reason why is you had 3 quarters of reporting with inflation being well above 8% and currently sits at 8.3% today, and you knew the Fed was going to make some changes. People were going to start to settle into the market after the reporting on the 3rd quarter in October, which is when they actually report. FedEx came out earliest, and they reported some significant pro forma changes in their balance sheet and their projections of what they're going to do in 2023. And as a result, their stock price plunged a little over 20%. This all spins back around to one thing. Change is coming, and this month, more than any other month, will prove that out. If you're looking to buy, prepare to buy in 2023 as the market tries to adjust to the new normal. Thank you for tuning in. Click like, hit subscribe, leave some comments, ask questions. Tell me I'm wrong if you like. We'll see you next week.